Welcome everyone to the Paymaster webinar. And a couple of things. First of all, I hope your Friday is starting off great, and season's greetings. And all of you in Florida who are freezing because it's under 85, Romeo is going to be ordering blankets for y'all. No, okay, not really. But
I am wearing 2 shirts today.
I'm sure you are. Romeo's probably dressed in Sherpa clothes because if it gets below 80, he gets hypothermia. So
it's 79.
Oh my gosh, call the paramedics. Romeo's going to freeze to death. And this is a man that went to Iceland for vacation. One day he'll tell you about his near-death experience and his last testament that he left on his cell phone. But that's for another day. Today is all about learning and good stuff. So welcome. Today's session is being recorded. So don't say anything that could be used against you in a court of law, because we will have evidence. Also, we are going to be taking questions throughout. Our first 2 presenters will be Romeo and Kate, and they will be taking questions throughout their presentations. There's a little handy chat button down in the bottom right-hand corner. So if you have any questions, if you could please put those in the chat, that would be ideal, and we will address them as they come in. And our last speaker is Jasna, and she is going to be taking her questions at the end of her presentation. But there again, if you have any, any questions that you have, just go ahead and put them in chat. Also, at the bottom where you see the little hang up button, don't hit that yet. Hopefully we haven't done anything to make you want to hang up quite yet. There's a little hand, like talk to the hand. That's if you have something pressing that you must ask us right away. You can raise your hand and we will get to you. So we really just want you to soak up the information, enjoy your time with us. Most of you know Romeo. You knew him, for those of you who have been around for a long time, you knew him when he had short hair. And now he's got his long ponytail. That's a pandemic thing, but it's lovely. I have hair envy because he's got an awesome head of hair. But enough about that. Sorry. You shouldn't let me mock.
I'll never learn.
I know. It's like every time we do this, I keep thinking I'm not going to get the email to talk, and yet it comes. It's weird. He doesn't learn. But you're going to be really excited about our speakers today. Again, you all know Romeo. He is a plethora of information. His brain holds more information than most people forget in their lifetime. So he's basically like a walking, talking computer. And he loves what he does. He loves his clients. He loves his employees. He loves his family. He loves his dog. He's just a great human being. So we're all very lucky to have him. You will also be hearing from Kate. And Kate is probably got more information about the system than anyone you will ever meet. So she is going to be able to answer questions and clear things up and any confusion that's out there. She's going to be able to help. She's our go-to for everything with the system. And again, I don't think I've ever met anyone that knows it quite as well as she does. So we're very fortunate to have her today. And then we will be hearing at the end from Jasna from Slavic with some information about 401ks. So is there any pressing question quite yet before we get started? Romeo, I went on for 3 minutes, so you have time to prepare your presentation for today.
I'm all done now.
Are you ready? Okay, great. Well, I'm going to just go ahead and hand it on over to Romeo at this point.
All right.
And happy Friday.
All right, let's bring this up here. And there is also on the bottom right of the screen 3 symbols, a triangle, square, and a circle. I believe in there you can find Q&A and you can post a question. I think you can upvote a question, and I'll try to keep an eye on that as I go along. Also for the presentation, if you want to see the presentation larger on the screen and you don't want to see the faces, at the bottom to the right of the hand, there's 3 dots, the ellipsis there. You can go into that, change layout, and change it to spotlight. and that will make the presentation the large part of your screen area. So we have some housekeeping. Rhonda went over it. Feel free to post. We will post this presentation next week once it gets edited. We'll post that out. We'll send out an email to everyone who's in attendance, so you'll be able to watch it again. And again, and these slides are for discussion purposes. Things change. Your situation may be different, so keep that in mind. We're happy to answer questions that may pertain to your specifics, whether it's during the presentation or you can email us after. I have a long agenda today. If you are a Paymaster client, there's probably about 5–10% that applies to you specifically if you're a client. If you're not a Paymaster client, a lot of this information is valuable to you. It applies. So if you are a client, we are closed the 2 holidays you see there. They are Mondays, so it usually doesn't cause too much chaos in the payroll world. But if your check date happens to be on a Monday, of course, you'll need to arrange with your payroll specialist to do the payroll earlier. Or if you submit payroll on a Monday, you also may want to do it earlier or reschedule to Tuesday. All right, state unemployment. We get a lot of questions, what to send to us, and my response is just send us everything you may receive from the state or from the IRS for that matter. Worst case, it's garbage or duplicate information we already have, great. But in other cases, there is important information on these notices you receive. We do correspond with many states electronically where they do provide us your rate change notices each year. But some states are not up to that electronic speed, and we rely on you because they only send you the notice. So please forward to us any notices you receive, and we will make sure they're handled accordingly. When it comes to state unemployment, I put this slide up last year. I found the updated one for this year. The purpose of state unemployment is to build up a reserve for state to pay claims during times of unemployment. As we know, in 2020, 2021, many unemployment claims were filed. State reserve balances went down to practically nothing, and a number of states had to borrow money from the federal government to pay their unemployment claims. The important thing on this slide here is the 2 on the right, or 3 on the right: Illinois, New York, California. We see they're in the negative. All the other states are in the positive. So the purpose of or the objective of the states is to build up that reserve again. States do it in one of 2 ways. They either increase tax rates, and when someone sees an increased tax rate, they usually get a little grumpy. My tax rate went up. But the other way states build up their reserve is a little bit sneaky. They change the amount of wages that unemployment is calculated on for you to pay that rate. So even though your rate didn't go up, because that wage base goes up, you're paying more unemployment tax. So last year, many states were trying to build up that fund. So there were 20 of them that increased their wage base. This year, there's, I believe, 13. And there are a number of them that are on this list 2 years now in a row, and they're just continuing to increase their wage base. We do have a lot of clients in Florida. Our wage base is $7,000. It's been that since, I don't know, the 90s or maybe even before that. So we're at a very low wage base compared to some of these other states. As Paymaster, we will automatically account for this when we calculate your changes next year. The other unemployment that you pay, the federal unemployment, what many don't know is the rate is actually 6%. If you are having contributions to a state, so if you're paying to a state, the federal government gives you a 90% discount. That's quite nice of them. You don't normally get a tax discount, but you get a 90% discount, thus making your rate 0.6%. Now, what the federal government does with those funds is they hold on to them, and when a state needs to borrow money, or a state goes down to zero, they need to borrow money, they borrow it from this federal fund. The federal government does expect that money to be repaid to them. They have a 2-year loan. So if the state does not repay the money they borrow from the Fed within 2 years, then the Fed looks at collecting that money from every business in the state. They basically say, okay, if the state is not going to pay us back, we're going to get it back from the businesses. So how they accomplish that is they reduce that discount to the businesses in that state. On this screen here, I have the fund balances again. I put up 2022 and 2023 so we can see a comparison of how states are building up their reserve again for another mass unemployment. The vertical line down the middle is where states should be at. It's kind of the minimum recommended that a state should have in their pool. Down at the bottom, we can see that a number of states have built up a little bit of money in there since last year. What I find interesting is the state on the top here, Wyoming, is 2.5 times over the recommended amount. Yet, going back to this slide, down at the bottom right, for the last 2 years, Wyoming has increased their wage base. And it doesn't make sense to me why they're building up even more money in Wyoming to pay unemployment claims, because they obviously have quite a bit of funds there. So the states in red are kind of in the warning area. They're below the recommended. And, we do see Florida kind of down here in the middle. But again, Florida has not changed their wage base since almost the beginning of time. These are the amounts of the loans these states took from the federal government to pay unemployment claims. And they had a deadline of November of last month to pay off the loan, to stay out of that penalty rate from the Fed. Connecticut and Illinois were small enough balances. They paid it off. So that left California, New York, and the Virgin Islands. So that means if you have employees in those states, I guess namely California, New York, you have a 0.6% additional unemployment tax. So your federal unemployment is already 0.6%. So in essence, as of last week, there's a surprise double tax rate that businesses in those states will have to pay retroactively, and this will be paid in January. So you basically have about 30 to 60 days to pay the double tax. Again, if you're a Paymaster client, we're going to handle this automatically. You'll receive our quarterly tax package in January, and in there we're going to reconcile and determine the additional tax that's due, collect it, and remit that to those states. All right, so that's kind of the end of my first part here. So I'm going to turn it over to Kate. Kate, do you want to share your screen, or do you want me to?
I will go ahead and share mine.
Perfect.
So Rhonda gave you kind of a little brief introduction for me. I am fairly new to Paymaster, but I have been in the payroll industry and working in HCM for about 8.5 years now, and have come here as a sort of trainer, so to speak, both internally and eventually externally, with some of you showing you different things in the system. So the first thing I have today is something a lot of employers don't really think about, and that is the fact that some of the fringe benefits that you provide to your employees are actually taxed. They have a value associated with them that the employee will then need to pay taxes on. There is an IRS document, publication 15B, that kind of goes into the details of some of these exclusions that they would not consider taxable. Some of those would be any employee discount programs. If you provide a cell phone for the employee to use, group term life insurance that is paid for by the employer up to a certain amount is tax-free. Anything over $50,000 of coverage would need to be reported and then taxed on behalf of the employee. Any health benefits, and that includes HSA, health reimbursements, dependent care assistance would not be taxed. If you are providing meals on premises, then we have things that you would need to account for. If you provide gift cards, gift certificates, cash awards, or cash equivalent, so things that have that actual like cash value to them. If you provide a company vehicle to your employee and they use it all the time for everything, the amount of usage that would be personal would be considered a taxable fringe benefit. So if 50% of the time that they have that car, they are using it for personal use, 50% of those miles are used for personal use, that has a value that can be calculated and is reported as actual income on the employee's W-2. Something else that needs to be reported at the end of the year on a W-2 is what is known as 2% shareholders health insurance. For S Corps, any owner that owns more than 2% of the shares of the company, if the business pays for their health insurance, that is taxed. It is not subject to Medicare or Social Security taxes, but it is subject to both federal and state withholding for the employee. So that would be reported on their W-2 so that it is accounted for when they do their taxes. Something that is a big topic this time of year is supplemental wages. Those, generally speaking, are going to be bonuses, commissions, vacation payouts, large amounts of back pay or severance pay. There are a few different options for paying them out and taxing them. We can run them as a completely separate check from the employee's normal wages and assign very specific taxation to just that. Or we can include it in an employee's normal payment and just apply the same taxation rules. There is also what is called a supplemental tax rate that a lot of times should be applied to these large payments, and that is a flat 22% of federal withholding. Or for larger amounts, there's that flat 37%, which is pretty rare that you would see it. But it does also, prevent the employee owing large sums at the end of the year. So if we take a look at some examples of the different way that we could do this, and there is, of course, on our website, calculators where you could run these scenarios yourself. But if we have a $500 bonus that gets paid out to an employee, and we pay them out separately, we can see that the employee paid $52 in federal tax in their regular check. Then in the $500 bonus taxed at that supplemental rate of 22%, they paid $110 in federal tax. But if we combine them all in one check and allow those, normal taxation rules according to their W-4 status, they paid a total of $112 in federal tax. So running it in those different ways, there's a difference of about $60 in federal tax, which, on that surface level seems pretty small. But if this happens multiple times throughout the year, that can actually add up and can make a big difference to the employees' end results when they actually do their taxes. So it's something to think about, something to potentially discuss with employees, especially commissioned employees, because you don't know their entire tax situation. So it's something to definitely think about and discuss. Deadlines to keep in mind in the coming weeks. W-2s and 1099s have to be distributed to your employees by January 31st. That means that they need to be postmarked by that date, not necessarily in their hands, but we have to have that postmark of January 31st. They also have to be filed electronically with both the IRS and the Social Security Administration by January 31st, or you could potentially face penalties at that point. So it is very, very important that any of these adjustments that need to go on your W-2s are submitted to Paymaster as soon as possible, because we will start processing those W-2s as soon as you process the last scheduled payroll of December. And we start that early to ensure that everyone's W-2s are completed, as soon as possible, so that we're not waiting until the last minute to file all of that. For the W-2s in HCM, employees do have the option to receive their W-2s electronically. If they choose to receive them electronically, they will not receive a printed copy. So if you happen to notice that, your stack of W-2s that you receive from us seems pretty slim, you can check in HCM to see if your employees have actually opted to receive that electronic W-2. Once an employee, or if an employee is terminated, they will not receive that electronic W-2. They will actually receive a printed copy. This is the same process that we had last year. So if you went through this last year, you'll be familiar with it. There is a post on the Paymaster blog as far as, details on what all of the different boxes on the W-2 actually are, what they do. Big reminder every single year is that box 1 on W-2 is not going to match an employee's gross wages from that last pay statement of the year. I've had multiple years where I've had multiple employees come back and say, well, I did my taxes with my last paycheck and my W-2 is wrong. And that's not the case. Any pre-tax deduction that the employee has, whether it's health insurance, retirement contributions, HSAs, those are all already accounted for in those box 1 wages. They are not subject to federal tax, so they will not be listed in that box. So that is, if you have employees come back to you and say, they have a problem with your W-2, that's going to be the first thing that you're going to want to have them look at, is what deductions they had that they need to account for when they're reading it. If you have any employees with an invalid Social Security number, say you did not have it at the time that they started with you, now is the time to get that updated before we submit all of that information to the SSA in January. Anything that starts with a 9 is not a valid Social Security number for work purposes. So double check that. Make sure you don't have anyone starting with a 9, that you don't have anyone that has a Social Security number that resembles something like 1, 2, 3, 4, 5, 6, 7, 8, 9. Anything that's a placeholder in there. Get that updated information to us as soon as possible so that we have the W-2s correct and the information submitted to the Social Security Administration is accurate. 1099s. Some of you may remember that a couple of years ago, they changed the 1099s. It used to be everyone was reported on a 1099 miscellaneous, and in box 7 indicated that it was what's known as non-employee compensation. That's a self-employed person doing work for you. In, I believe it was 2020, they broke that out, and those box 7 people now have their own form. So any independent contractors you have working for you will now receive a 1099 NEC, and the 1099 miscellaneous, that's going to be reserved for things like payments for attorney fees or rent, any royalties that you pay out, that type of thing. So if in the past you have seen those 1099 miscellaneous forms, you will likely now be seeing them as 1099 NECs. ACA reporting, it's that time of year as well. Going back to ACA, it's the Affordable Care Act that's been in place. This part of it has been in place since 2015. Any full-time employee is going to get this 1095 form. If you are a self-insured company, meaning you personally fund all of the health insurance, it's going to be a 1095B that's also going to report dependent information. If they've worked for at least 1 month as a full-time employee, they're going to get this form. Not every employee is necessarily going to get one. If they were part-time and they were not required to be offered health insurance, they're not going to get a form. If they did not complete a full month before the end of the year, they're not going to get a form. So again, just going, similar to the W-2s, if you notice the stack is a lot smaller than you think it should be, you can check that in HCM. Were they full-time? Did they work long enough to actually generate a form? You should be getting, if you are a current Paymaster client that uses our ACA services, you should be getting quarterly little newsletter reminders of what you need to be looking for, make sure you're on top of it, that kind of thing. We will also start processing these probably the beginning of January so that we can get those printed, delivered, all out to you, filed with the IRS. As I said, the 1095Bs, they are for employers that self-insure their health insurance. A 1095C is going to be a third-party health insurance. Wage base increases for 2024. The wage base for Social Security taxes is going up to $168,600, meaning you will pay that 6.2% Social Security tax, both you and the employee, on the first $168,600 of wages in 2024. 401k, 403b contribution limit is increasing to $23,000, with the catch-up for employees over the age of 50 increasing to $7,500. Simple IRA is increasing to $16,000 with a $3,500 catch-up. An IRA maximum of $7,000. HSA is increasing to $4,150 for a single policy, $8,300 for family. Catch-up is still $1,000, which has been for a few years now. FSA is going to be $3,200, and the qualified small business health reimbursement accounts are increasing to $6,150 for a single and $12,450 for family. There are a number of minimum wage changes for 2024. Most of them go into effect on January 1st, but there's exceptions to every rule. There is a blog post that went up, I believe it's about a week ago, that actually lists all of those minimum wage changes. And if there are any alternate dates other than January 1st, those are listed as well. A reminder that the date listed for that change is for hours worked. So anything worked as of January 1st is going to be at that new rate, regardless of when it is paid. Certain cities and counties also have their own minimum wage. Those changes that we are aware of are also listed. It's not a 110% comprehensive list, but we try to include as much information as possible. There
There's a
are
lot
also
of counties out there.
there's a lot of
There's a
counties and
lot of
cities
counties.
out there, and we can't possibly get them all. So if you happen, it's always a good idea to double check if you have, a lot of employees in any particular municipality that may have that minimum wage. Double check to make sure, you know what it is. The W-4. Now is the time of year when you're going to start getting a lot of questions from employees that are going to do their taxes, and the results are not what they expected. Either they thought they were going to get a big refund and they aren't, or they're accustomed to getting a refund and now they owe. That is kind of the theme of the last few years, is people not getting back what they're expecting at the end of the year, because the government redesigned the W-4 form in 2020, and it serves pretty much a different purpose than it did in the past. The purpose now is to get that end result to be as close to the actual tax liability as possible, so that there aren't these large variances. There aren't large refunds. People aren't owing large amounts. That said, the form is a lot more complicated and detailed than it used to be. It's not just, claiming two dependents anymore. You need to put actual credit dollar information for all of that. There is a video that Romeo put together last year, available on our website, that kind of goes over that for employees. There is also a resource on the IRS website, a withholding calculator that they can log in and do. It is actually really neat. It lets you kind of customize what you want that end result to be. It will default, to you not owing anything and you not getting anything back. But if, some people like getting those large refund checks back. So if they want a refund at the end of the year, they can tell the system that, and it will tell them exactly how they need to fill out their W-4 in order to have that end result at the end of the year. So it's definitely a great resource for your employees to take advantage of for that purpose. Big reminder that there is this new checkbox on the W-4. This is if there are multiple sources of income, more or less, for your household. If you are filing as married and your spouse works, you need to have that box checked. If you work multiple jobs, make sure you have that box checked. It makes a huge impact on what is actually withheld and what you're going to end up with when you do your taxes at the end of the year. So make sure that employees are reading that information and checking that when that is appropriate. And I am going to turn things back over to Romeo.
All right. Let's go over here. All right. Yeah, that checkbox, we find that as the biggest, I would say, mistake that employees make when filling out the W-4 form. There's so much text in that area, and it's such a little box, and people don't read, they miss the box, and I've kind of calculated not checking that box when they're supposed to could mean almost about $1,000 in withholding, and that could throw someone off a lot. One other thing I wanted to bring up on a previous slide on the 1099s, this is a change for this year. The electronic filing requirement threshold used to be, I believe, 250 forms, which was a huge number. That has dropped to 10. So if you file 10 or more 1099s, in the old days, or say last year, you were able to go to Office Depot, pick up some forms, handwrite them, fill them out, and mail those to the IRS. If you have more than 10 forms, they are now required to be filed electronically. And the 10 forms includes all employment and 1099 forms. So if you have, 5 W-2s and 6 1099s, you have more than 10 forms, and you're going to have that electronic filing requirement. as Paymaster, even though we are a payroll service for employees, we do also handle 1099s, independent contractors. So that is something we can file. All right, back on track. This is a topic I like bringing up as much as possible whenever I can. We unfortunately see this on too often of a basis. There are reloadable pay cards that you can get off the shelf or online. There's a picture of a display, and I don't know if that's a Walmart. You are basically buying a bank account for, it was American Express for $1.95. You buy a bank account, and what the criminals do is they get that routing and account number. They impersonate an employee, try to get you to change the direct deposit account to this reloadable card. If you take the bait, you make the change, the employee's direct deposit is diverted to this pay card, and a criminal can make off with it without a trace. They do a cash withdrawal and they're gone. So the best way to combat this fraud is that any direct deposit change request you get in some sort of electronic manner, so if it's faxed to you or emailed to you or texted, do not make the change. Pick up the phone, get on a voice call with that employee, or in person is even better, and confirm, hey, I received your notice to change your direct deposit account. Is this something you want to do? We do hear instances of real bank accounts being used as well. So Bank of America accounts, those are a little bit harder for the criminals. They do have to use a money mule or an intermediary to commit the fraud. From what we see, probably 99.9% of the time, we see fraud being committed with these reloadable cards. You may not even know because you're just provided a routing and account number. So I just suggest getting that verbal from everybody. My last kind of two slides here are about tax credits. I think at this point, this is the beating a dead horse. ERTC, it's still out there. It's going to expire in about 4 months. If you haven't filed, a little bad news right now. I just saw as of last week, the IRS has backlogged 1.1 million returns. So if you file now, there's at least 1 million returns ahead of yours. We were seeing these processed in about 5 to 6 months when the IRS was down about 500,000 returns. So I'm suspecting you could be looking at a year for it. There are other credits that are available, and we get this asked quite often. Hey, I did the ERTC. What else is out there? The WOTC, or Workforce Opportunity Tax Credit, this has been around for decades. It is a federal tax credit. It is taken off of your corporate tax return, so you kind of take it immediately. You don't have to wait for the IRS to process and refund to you. The credit is typically $2,400, but it could be up to $9,600 per new hire. Even though it's a tax credit, it is available for nonprofit organizations, so you're still able to participate. And we can do an hour-long presentation on this, so just kind of summarize it. These are the 8 or 9 targeted groups that if you hire someone from one of these groups, you are potentially eligible for a credit. The last one on here, it was 8. The last one was added recently, and that is if you hire someone who has been unemployed for at least 27 weeks, and at some time, maybe just 1 week, they collected unemployment benefits. If you hire that worker, you're eligible for this credit. So there's this credit is out there. If you have questions about it, we're going to send out a survey after this webinar on Monday, and you can check the box if you'd like more information. So that is the end of my presentation. I'm going to go ahead and turn this over. So, Jasna, yeah, you are
Hi,
here.
Romeo. Yes.
And just a
So-
reminder, everyone, if you have any questions for Jasna along the way, go ahead and put them in the chat and we will get them addressed at the end of her presentation. Take it away.
Thank you. Okay, let me just try and share my screen.
Sure.
And someone just let me know how I would do that.
On the bottom of the screen, there's
Yeah.
a box with an arrow pointing up.
Oh, okay.
Yep, click that. You can select a window
Okay.
and
Oh,
share away.
great. Okay. Here we go.
Perfect.
Okay, excellent. Well, thank you, everyone. Yes, as Romeo said, my name is Jasna Jurin, and I am the Senior Director of Compliance at Slavic 401k. And I am happy to go over some of what I thought are the most relevant provisions of Secure Act 2.0. So, I have 20 minutes, but there are over 100 provisions under Secure. So I've picked some that I thought would be of most interest to the audience here. So just in the way of introduction, back in 2019, we had first legislation that was passed into law that we refer to as Secure 1.0. And then following that in 2022, we had Secure 2.0. Both Secure 1 and Secure 2 include, as I said, over 100 provisions that are aimed at modernizing and enhancing retirement plans and retirement savings. And many of the provisions are mandatory, meaning retirement plans must adopt these provisions, but most of them are optional. And I just want to kind of say in advance that even though these provisions, a lot of them are already in effect or are going into effect next year, we are still awaiting guidance from the IRS on a lot of these to be able to really properly administer them. So many of the provisions under these regulations, especially the ones that are optional, you're not going to see many plan providers offering those at this point because, as I said, the guidance that is still needed by the IRS. But for today's presentation, I kind of picked a few of the provisions that I thought would be of most interest to you. One is the small employer tax credits that were introduced under Secure 1 and then modified, enhanced, and a few additional tax credits were introduced under Secure 2. And these tax credits are in effect right now, so for 2023. There are many provisions that were introduced that are changing regulations regarding Roth contributions in 401k plans and catch-up contributions. Also, there are provisions that are aimed at enhancing retirement savings, so expanding the retirement plans to more workers, and also introducing mandatory provisions that are aimed at enhancing retirement savings among American workers. And finally, if we have time, I'll go over some of the changes to the regulations pertaining to required distributions from 401k plans. So initially, first I want to discuss the small employer tax credits that, as I said, were introduced back in 2019, but were enhanced and additional tax credits were added under Secure 2. So there are three main tax credits that I'm going to discuss. One is a tax credit if you don't have a retirement plan at this point, if you want to start up a 401k plan. There are tax credits that are now available for costs associated with starting your 401k plan. In addition, they have added two tax credits. One is for employer contributions to 401k plans. So if you set up a 401k plan and you want to offer a matching contribution or a profit sharing contribution, you can now get a tax credit for some of those contributions. And then finally, for automatic enrollment in a 401k plan. So the government is really trying to encourage employers, especially small employers, to set up 401k plans and offer their workers an opportunity to save for retirement. So one of the provisions that I'm going to discuss later that's becoming mandatory for all 401k plans is automatic enrollment. But luckily, you can get a tax credit for if you have that provision in the plan. So I'll go over it in a little bit more detail about that. So when it comes to the startup credit, these tax credits are really aimed towards small employers with 100 and fewer employees, and for employers that are starting new 401k plans. So, if you've had a plan in existence for many years, you would not be eligible for some of these tax credits. So if for the startup credit, what are the costs that are eligible? So really any costs that are associated with starting your plan. So if, let's say, your service provider is charging you, let's say, $1,000 for the setup of the plan, that can be, that's eligible for the tax credit. Any advisor fees or document fees, that's also eligible for the tax credit. And this tax credit is up to $5,000, right? So if you're an employer with 50 or fewer employees, you can get a tax credit for 100% of your costs associated with starting a 401k plan, up to $5,000. Now, again, you must have, there are certain qualifications that, I'm not going to go into too much detail on, but it's really the tax credit is the lesser of $5,000 or $250 times the number of eligible employees that you have. And these employees have to be non-highly compensated employees. Then if you're an employer that has over 50 employees, but fewer than, but 100 or fewer employees, then the tax credit is reduced to 50% of your startup costs. And then if you have more than 100 employees, unfortunately, you're not eligible for these tax credits. The tax credit that was introduced under Secure 2 is the tax credit for employer contributions. So if you're offering a matching contribution or a profit sharing contribution, you can get a tax credit of up to $1,000 per employee. Employee has to make under $100,000 in FICA wages. So this is really cutting, can cut the cost of sponsoring a 401k plan. So for example, if you have 20 employees that all make under $100,000 and you're offering each of them a matching contribution of $1,000, you can get a tax credit for the $20,000 that you're providing in matching contributions. Now, I'm not going to go into detail on the calculation here, but this tax credit you really do have available for 5 years from the year of adoption. It slowly gets reduced. You can see the tax credit is 100% of employer contributions the year of adoption, the following year, and then it's reduced to 75%, 50%, and 25%. And then if you're an employer with more than 50 employees, the tax credit gets reduced. And then there's the tax credit for automatic enrollment, as I mentioned. If your plan has an automatic enrollment feature, you get a tax credit of $500 for 3 years. This tax credit does not apply only to new plans, new 401k plans, but even to existing plans. If you adopt the automatic enrollment, you have this tax credit for 3 years. Again, it is for employers with 100 or fewer employees. So all these tax credits, as I said, are aimed at small employers that are setting up new 401k plans. So the first one, the startup credit, you have it in effect for 3 years. So you get the tax credit in the year that you adopt the plan and 2 subsequent years. The employer contribution credit is available for 5 years, and then the automatic enrollment tax credit is available for 3 years. And as I said, these are available starting in 2023. Obviously, before filing for these tax credits, we always advise that you consult your tax advisor. And hopefully, the IRS is much quicker at processing these tax credits than the ERTC credits, but you never know. So the next that I would like to discuss are changes under the Secure 1 and Secure 2 to Roth and catch-up contributions. So if you currently sponsor a retirement plan, you probably know that employees can defer to the plan both on a pre-tax and Roth basis. And employees that are 50 years or older can contribute an additional contribution, right? So for 2023, that additional catch-up contribution is $7,500. And currently, the regulations allow for that catch-up contribution to be contributed either pre-tax or Roth after tax. Major change under Secure 2 is pertaining to this Roth catch-up. And it states that employees who are making over $145,000 are no longer going to be able to defer the catch-up contribution on a pre-tax basis. It will be mandatory that Roth catch-up contributions for these employees be contributed on a Roth basis. And this provision was supposed to go into effect in 2024. But luckily, they provided for a 2-year transition period so that up until 2026, employees can still do the catch-up contribution pre-tax. And again, just to emphasize, this provision only applies to employees who are considered high-paid employees, and the compensation is $145,000 or more. So with this provision, a lot of payroll companies and service providers need to prepare to actually put this provision in place. That's why the IRS actually granted this 2-year transition period, because everyone in the industry was complaining that, no one in the industry is really ready to administer this provision. In addition to that, there's a change to the catch-up contribution limit for employees that are ages 60 to 63. So as I mentioned, for 2023, the catch-up contribution is $7,500. Starting in 2025, employees that are ages 60 to 63, their catch-up amount is going to be increased to 150% of what the regular catch-up amount is. So if this provision was in effect right now, that means these employees would be able to contribute $11,250. This provision, as I said, is going into effect in 2025. It is not mandatory, so plans do not have to adopt this provision, but I do suspect that most plans will want to add this to their plan. Another provision that you may have heard about, and I know we get questions from clients, is the ability to contribute the matching and non-elective contributions, profit sharing contributions to the plan as Roth. So currently, if you have a 401k plan right now, when you contribute a matching contribution to your employees or a profit sharing, those contributions are pre-tax. The new regulation is saying, okay, employees can elect to have their matching contribution contributed on a Roth basis. This is in effect right now, but almost no plan sponsors have this in place, and this is because we still need a lot more guidance from the IRS on this. So this provision is most likely you're not going to find it available in any of the plans, or any service providers are not providing it. However, there is a similar provision that is already in effect and available, and that is that if you do have a 401k plan and an account, and you have pre-tax contributions, matching, profit sharing contributions, at this point you are able to convert those pre-tax dollars in your 401k plan into Roth contributions. So I think that's why you're not going to see the provision under Secure 2 be adopted so quickly, because something similar is already available. So the difference is, instead of having the match contributed to the plan as Roth as it's going into the plan, once the contributions are actually deposited into the plan, at that point you can actually convert it to the Roth contribution. So, so again, we'll see. We're hoping more guidance comes from the IRS, and if it makes sense, then you'll see more plan sponsors offering this. Two additional, we're running out of time soon, so I want to just point out two additional important provisions. One is that if you're an employer with a large population of part-time employees, under the previous regulations, you were able to not allow them into the plan by requiring these employees to work 1,000 hours in a plan year. Secure 2 has made changes to this, and it's making it easier for part-time employees to now be able to participate in 401k plans. This provision is going into effect in 2014, and the provision states that if you have employees that are working for you for many years and they complete at least 5,000 hours of service in 3 consecutive years, they're required to be allowed to contribute to your 401k plan. You're not required to offer them a matching contribution or a profit sharing contribution, but you are required to allow them to defer from their own paychecks into the plan. So again, this is effective in 2024. In 2025, Secure 2 made a change where employees have to work only, you're looking only at 2 consecutive years versus 3 consecutive years. But again, they have to work a minimum of 500 hours in 2 consecutive years. And then starting in 2025, they must be allowed to contribute to the plan. One important the provision regarding the long-term, they're called the long-term part-time employees, is mandatory. So, it must be adopted. The next one that I want to mention is the automatic enrollment. Starting in 2025, any new plan that is set up starting in 2023 must adopt automatic enrollment effective 1/1/2025. So if you are an employer that set up a plan this year or will be setting up a plan next year, and you don't have automatic enrollment as part of your plan, in effective 1/1/2025, you will have to amend your plan to include automatic enrollment. And then any employers that are starting new plans, in 2025 and on, will just have to have automatic enrollment in their plan. And that automatic enrollment is going to have to start at 3%. So employees are going to have to be automatically enrolled in 3. They're going to have that automatic enrollment increase by 1% up to 10% of their paycheck. Employees are obviously going to be able to opt out of this provision. But it is mandatory starting in 2025. And then the last one that I wanted, there is another provision that's out there that not many plan sponsors are putting in place, and that is matching on student loans. And the reason why you don't see that very prevalent in the industry is, again, because we are requiring more IRS guidance to actually properly administer that provision. And then the last one that I'm just going to mention that's in effect now is that if you have older employees who are required to take distributions from the plan called the required minimum distributions. The age at which they have to take the distribution has increased from 70 and a half to 72, and currently the required minimum distribution age is 73. So those would be the topics that I chose, and I know we're out of time, but if there are any questions, I would be more than happy to answer those.
Yeah.
There are
Sounds
no
like
questions in the chat. Does anyone have any questions for Jasna?
I have questions.
Romeo, Romeo, what is your, oh, and we have Gabe has a question. It looks like he raised his hand. Cindy, can you unmute Gabe?
She may have to make him a contributor, I think, depending.
You can do
While
it.
we're waiting for that, I mean, it sounds like if you were remotely thinking about putting in a 401k plan, that now is the time to do it. It seems like just the number of credits or amount of credits that are out there. My one quick question. So if you have an existing plan prior to 2022, there is no automatic enrollment. You're going to be required yet, or maybe Secure Act 3.0 comes out. They might.
They may, right. So
That's
any plan that was set up prior to 2023 would not be required to adopt the automatic enrollment. Any plan that's set up in 2023 will have to adopt it effective 1/1/2025. Same, any plan that's going to be adopted in 2024 will have to adopt automatic enrollment in 2024. So we kind of encourage plans that are being set up currently for the first time to just add the automatic enrollment instead of having to amend it, effective 1/1/2025.
I was going to say, do you see Gabe's question?
Yeah, I was just going to say, I have Gabe's question.
Okay,
and
go for
it's a two-part question, so I'll start with this. Because we switched plans last year from Co-Advantage to Slavic, does that count as a new plan for tax credit purposes?
Okay, so it does not count as a new plan. So yes, so it goes by the original effective date of your plan. The plan with Slavic is a successor plan to your previous plan, so it would not be considered a new plan for tax credit purpose. However, there's no clear guidance of that. So nothing in the regulations specifically state that, but just in the industry, the consensus is that these plans are not considered new plans for other purposes. So for tax credit purposes, most likely they will not be considered new plans as well.
There's more to that question, especially since we are now filing under our own EIN. With Co-Advantage, we were not, though I am not certain how our 401k plan was set up.
So they went from a PEO to the PEO's multi-employer plan to
Now they're under their own EIN.
To their own EIN, yeah.
Yeah. So again, because it's considered the successor plan, a continuation of the prior plan.
Yeah.
The consensus is not considered a new plan, but again, nothing in the regulations specifically address this. So this is just the interpretation and the consensus among industry experts and ERISA attorneys that it's not considered a new plan.
Also, it's being requested more information on 401k auto enrollment provisions and tax credits, please. So we will be providing Gabe with that. Excuse me. And then Dawn has a question. If a person had a simple IRA prior, would they not be considered to be a new? They would not be considered to be a new plan, correct?
Correct.
Okay. Okay, those
and
are
we have a handout that we can provide that describes the small employer tax credits summarized, so I can provide that to you, Romeo.
Okay, and we can put that out with the email that goes out to everyone.
Yeah.
And again, it'll be, if you want more information on this 401k plan starting, you can check the box and we'll get back to you on that.
Yep.
I did have a question that I was just looking at, and you mentioned the ratification of the employer match. So I know when the employer match is done now, no matter if the match is on a Roth or a regular contribution, it goes in essence, pre-tax.
Yes.
The employee pays taxes when they take the money out. So I'm thinking of this Roth employer contribution. Does that mean the employee pays taxes? So that employer contribution becomes taxable income to the employee at that time. Yeah.
Correct.
So that's interesting. Yeah.
Yes, yes. So, there's a few complexities there is how, first you need to figure out how is the employee going to make the selection. And then, as you said, how is the employee going to be taxed? Is it, on the W-2? Is it a 1099? So we don't have the answers to a lot of those questions. And that's why, you don't see that being put in place,
Gotcha.
correctly.
Okay.
Yep.
Well, it looks like our questions are completed.
Oh, wow.
I know y'all were just too easy on us. No trick questions, no hard questions. Thank you. You must be feeling the Friday vibes or something. So we appreciate it. But first of all, we would like to thank our panel, Romeo, the Wizard of Payroll, Kate, and Jasna. Also, thank all of you. We truly appreciate our clients. We know that you have other choices, and we are so glad that you've chosen Paymaster to be your payroll provider. I did want to reiterate, if you have not looked into the ERC, don't necessarily disqualify yourself based on some of the information that you've heard. Reach out to us. You can reach me, you can reach Romeo, and we can answer those questions. Again, some people have been surprised that they thought that they didn't qualify and they got a nice big fat check. So anyway, happy holidays to all of you. Have a wonderful weekend. And if you need anything at all, feel free to just pick up the phone, shoot us an email, do a smoke signal, whatever works best for you. And we will be there for you. So again, thanks everybody and have a wonderful weekend.
All right. Bye-bye,
Thank you.
Bye.
Bye.